The Federal Reserve has been under fire recently for owning securities that the central bank bought during the COVID pandemic. Now, we are not talking about the Federal Reserve itself. We're talking about members of the Fed who literally own stocks and or bonds. And then the Fed came in and was buying some of the assets that those individuals owned. Now, each person is different as part of this. But if you think about the general premise here or the framework for going through this, if I, as an individual, am in charge of monetary policy decisions and I am in charge of making decisions, whether I'm actually the decision maker or I have an influence in the decision of what we should be buying, what we should not be buying, etc. If I own assets, I obviously cannot be unbiased. So if I want to buy the assets that I already own using somebody else's money, the Fed's money, then that could be problematic. I also, by the way, could be problematic if I say, hey, rather than buy the assets I own, maybe we should divert money somewhere else. Again, that could be problematic as well. So it's not just bias of, hey, I should go and buy the things that I own. You influence decision-making in either direction, which is part of the problem. So what is the solution? Forget complaining for a second. Obviously, this happens in many industries. It happens with journalists. It happens with people in positions of power. It happens with politicians, elected officials, etc. So this is not a new problem. How you solve it is the real question here. And so what we know as of today, what I would consider fact or what has come out, is that Fed officials have been trading stocks and bonds that could be influenced, at least indirectly, by their policy decisions. So it's not a question of were they buying or selling stocks. That I think at this point is everyone agrees like that has been happening. The problem is what stocks were they buying? How much was that influenced by policy decisions, etc. And then some people want to start tightening the policy, but others want to wait. Of course, there's controversy around this or debate around this, probably more so than controversy. And so if you think about if you're the leader of the Federal Reserve, what should you do or what can you do? Well, what we've seen is Jerome Powell has ordered a review of the rules, the ethics, for the central bank, as people have started to say, wait a minute, hold on, that doesn't seem like that's cool that the officials own stock, but then they are also influencing the policy decisions. And so what we have is a CNBC article, great work by our outsourced research partner, CNBC. And what they've said is that none of the holdings or transactions appeared to violate the Fed's code of conduct. So nobody is alleging, at least from what I understand today, that there's actually been a violation of the code of conduct. But there are questions about the Fed's conflict of interest policies and the oversight of central bank officials. So what exactly does that mean? It means that nobody is claiming, hey, you broke the rules, but a lot of people are saying maybe the current rules shouldn't be the rules. So what we do know, according to this article, is that Jerome Powell held between $1.25 and $2.5 million of municipal bonds. They were just a small portion of his total reported assets. He's really, really rich, so this is actually a small amount. While the bonds were purchased before 2019, so way before the pandemic, they were held while the Fed last year bought more than $5 billion in the muni bonds, including one from the state of Illinois, which was purchased by his family trust in 2016. So let's stop here, time out. Jerome Powell first. Two important things. One is my understanding of kind of doing all this research with the Best Business Show research team, the best in the world, is Jerome Powell has a family trust. And that family trust, he is not the one that's actually making the decisions, right? And again, you can debate, is he making the decisions? Is he not? Does he have influence? Does he not? Whatever, people will figure that out. But as it stands, according to the current kind of structure, is there's a family trust. He is not the sole decision maker. He is not the one who's saying, buy this, sell this, buy this. And so on top of that, most of the assets that are in question, and I put that in air quotes because some people think they're in question, some people don't, are things that were bought before the pandemic. So when it comes to Jerome Powell, right, a lot of people like to give him a lot of shit. We've definitely questioned some of the decisions he's made here, but I think it is important to also call out, I don't actually think that he's doing anything from what we know today that seems to be out of bounds, right? There's a bunch of assets that they previously bought, they held. Hey, if you're a long-term holder of assets, then of course you're gonna hold the assets regardless of if it goes up or down, kind of just good investing principles. But also, on top of that, it's inside a family trust, which he is not the decision maker. Now, with that said, if he knows that, hey, I have municipal bonds in my family trust, and yes, I didn't make the decision to buy them during the pandemic, but guess what? If we go and we buy it with Fed money, could it actually prop it up? Absolutely. And so ultimately it gets to the point of if you're not making the decisions in real time, if you're not actually the one making the investment decisions, and these are assets you already held, the only other thing you could ask him to do in this situation is not to have the assets. Is to literally just hold cash or to hold some sort of like index fund or mutual fund or something like that. So this seems to me like Jerome Powell has set himself up in the best possible place outside of simply having no investments. Now, I don't think that we should punish people for getting into these positions and say you can't have any investments, but I think that this is actually probably the best structure that we've seen so far, given what we know today. Now, on to the next person. The Boston Fed president, Eric Rosengren, he held between $150,000 and $800,000 worth of real estate investment trusts that owned mortgage-backed securities. This is the part that gets a little crazy. He made as many as 37 separate trades in the 4 REITs while the Fed purchased almost $700 billion in mortgage-backed securities. Now, going back to Jerome Powell, comparing these two. Jerome Powell is allegedly not the one making investment decisions. We have no reason to believe that he's actually day trading this stuff or making kind of frequent trades. Eric Rosengren, 37 trades is a lot in terms of if you're trading in and out of 4 REITs that hold the assets of which the Fed is literally putting hundreds of billions of dollars into. Again, we start to get a little bit more into the slippery slope here around what is okay, what is not okay. How much of those trades would not have happened if he wasn't there as in that position? How many of the trades would he have done that he ended up not doing because he sits in the position? Maybe he actually historically did 100 trades in this time frame, and now he only did 37, so he's actually brought down his trading. There's a lot of context missing, but again, I think people get really uneasy when they see somebody doing 37 trades of assets that the Fed is pouring so much capital into. So let's keep going. The Richmond Fed president, Thomas Barkin, he held between $1.35 million and $3 million in individual corporate bonds purchased before 2020, before the pandemic. They include bonds of Pepsi, Home Depot, Eli Lilly, and the Fed last year opened a corporate bond buying facility and purchased $46 billion of corporate bonds. Now, here is what I end up thinking about. One, if you already held the assets, it ends up being a lot less kind of concerning, right? If you bought the assets before the pandemic. Okay, maybe that's fair, maybe that's not, but I just think psychologically people are like, okay, you already held this thing, you didn't make any different investment decision, and so it is what it is. If you're actively trading during the pandemic, nobody can fault an individual investor for doing that. That's how you end up reacting to the market. But the problem is that when you're doing that and also having an influence in policy decisions, that's where people get uneasy. So I think that all of the assets that were previously bought, most people are eventually just going to say, they already held the assets, not a problem. On top of that, if there's some sort of family trust or some sort of arm's length type mechanism, again, it may not be perfect. Some people may have concerns about it, but it is better than literally me going into like an E-Trade account and like firing off day trades, right? So obviously having some sort of at least appearance of distance between the policymaker and the assets they own makes it much better. I think the big thing that people end up getting really, really worked up about is when they see folks actually day trading, right? Or frequently trading assets that also the Fed is buying at the same time. That to me feels like they're like, I don't know if that's really what we want our policy officials doing.
Yeah, when you break this down, right, Jerome Powell, if he does have a trust and if he can't, if he doesn't make any investment decisions on that trust, that's totally fine. But as we said before, no one is unbiased, right? They may not have let this influence their decisions on what they do with the policy, and they may not have even thought about their own financial situation, gain, loss, whatever it may have been. But look, they know in their own mind what they own, what they don't own, and they're making decisions that both affect themselves and our nation financially. So we're going to see. But yeah, obviously actively making trades while you're kind of deciding what to do is a pretty big red flag.
The first quote we have here is from Joseph Lavorgna. I apologize, I'm probably saying it incorrectly. He's the chief economist for the Americas at Natixis. Joseph said, quote, "The ethics here look bad. They should have known better. Once you lose that moral authority, it's a problem." I think it's a very, very good point, which is regardless of if you're actually doing something wrong or not, the appearance of it is much more important in some way, because everyone historically has thought of these institutions as having that moral authority. They're always trying to do the right thing. They may not always be right, but they're always acting in good faith. They're always doing the right thing. If you lose the moral authority, that's where very quickly the confidence game gets shot. There's trust that unwinds, and like that, and we can kind of spiral into a bad place pretty quickly.
Yeah, well, it's a credibility thing, right? So once you lose that credibility with the public and with other officials and authoritative figures, it becomes a really, really big problem. And look, it's sad, but you also get more scrutinized after the fact, right? So then every decision you make from there on out is heavily scrutinized because they know you've done something wrong in the past, whether it's true or not. It's a credibility issue.
The next quote that we have here comes from Christopher Whalen, the chairman of Whalen Global Advisors. I appreciate you, Christopher, made this real simple for me. He said, quote, keep in mind, they already have trading rules they imposed on banks, for example, and yet the Fed's governors don't live by those same rules. After Dodd-Frank, the post-crisis banking reforms, every agency in Washington tightened up little conflicts like insider trading, and yet the Fed is somehow exempt from those rules. They look ridiculous. Now, we're getting a little bit more spicy with what people are saying here. I think this is a very fair point as well. So one is, once you lose the moral authority, there it becomes a problem. Second is, if all of a sudden there's a ton of rules that everyone else in the industry has to operate alongside or abide by, but you as the policymaker don't have to do it, again, they look ridiculous, right? That, not my words, his words. But I think that is the sentiment. Is people say, wait a second, hold on. After 2008, 2009, all these other organizations tightened it up. They said, hey, look, maybe we shouldn't allow people to do A, B, or C things. But the Fed didn't do that. And so that's where people are saying, I think that this is a problem. And so my guess is, if they move and they make rule changes, regardless of how severe the rule changes are, people will say, okay, at least they're headed in the right direction. They may not like the rule changes. They may not think they're aggressive enough, but at least they feel like, hey, the Fed is listening. They're actually changing stuff. But I think this is a very fair point where people say, look, if all of a sudden that other people are having to live by these new rules and every other agency in Washington tightened up little conflicts like insider trading. Side note, the fact that we're calling insider trading little conflicts is pretty crazy to me. Like maybe it's a big conflict if you're insider trading. But the point here about the Fed is somehow exempt from those rules doesn't actually sit well with people. And so I think they're going to have to end up making some changes here, right?
Yeah, I agree. Look, the problem is, and we were talking about the solution earlier, is that like, what do you do? And one of the solutions is, well, maybe they can't own stocks or bonds directly in the sectors that they kind of regulate, but that's not really a viable solution, as you want to be able to have, you want them to be able to like own anything really, right? But look, it's unbiased. It's no matter what, they're in a bad situation. No matter what decision they make and investments they buy, they're going to be scrutinized no matter what.
Last quote we have is from Dennis Keller, the CEO of Better Markets, said, quote, to think that such trading is acceptable because it is supposedly allowed by the Fed's current policy only highlights that the Fed's policies are woefully deficient. Should people at the Federal Reserve not be allowed to hold assets outside of low-cost index funds and or mutual fund types things, where they basically are just buying baskets? They're not picking individual securities. They're not picking individual bonds. They're not able to pick individual commodities. It's more of, you can get broad-based exposure to the market, but part of your duty in serving in this role, in having the privilege of serving in this appointed role, is to give up some of the economic upside that you could gain by playing the markets and investing in other assets.
Agreed. It's also, their code of conduct is a little vague, right? So I want to read an excerpt from it that says they should be careful to avoid any dealings or other conduct that might convey even an appearance of conflict between their personal interests, the interests of the system, and the public interest, right? So it is a little vague. It's basically like, hey, don't do anything unethical, right? That's what a code of conduct is. So it's, look, they're in a bad situation. I don't think that we should financially harm people or not let them own certain stocks because they're making policy decisions on those stocks, but you just have to, it has to be watched very, very carefully.
So if you look at the Federal Reserve Board salaries, according to Glassdoor, again, could be a little off, but directionally probably correct. Economists get paid base pay $167,000 with about $25,000 of additional pay. So they come in right below $200,000 or so total pay. A research assistant can get paid about $65,000, $70,000 a year. A senior research assistant could get paid a little bit more, kind of $75,000 or so. Interns, $25 an hour. Funny how they pay their interns $25 an hour. If we look at somebody like, let's say, a senior economist, they get paid about $190,000 to $200,000 a year, plus with additional pay, it comes in around $225,000, $230,000. And then when you look at somebody in the IT spot that's an intern, they get paid $26 an hour. So you get $1 extra an hour if you're a regular intern versus the IT. But even managers at the Fed are getting paid $160,000, $170,000 with the potential to earn up to almost $200,000. And so there are, for the staff, there are very high salaries, but that doesn't include the people actually who are on the thing. So if we look real quick, if we look at, let's say, Jerome Powell's salary, he is chair of the Federal Reserve. It's only $200,000, right? So it's not like it's a ton of money. If you said to me, instead of allowing them to play in markets, just go pay them $1 million a year. Pay him $2 million a year. Fine. Like we just printed $5 trillion. Like we got the cash, right? Just literally go, everybody who is a Fed president, pay him $2.5 million a year, $5 million a year. Like pay them whatever we need so that they're not out there YOLOing in the markets, making all these day trades and kind of periodic trading, so that we can try to get to some semblance of not having influence and bias in their policy decision.
What's up, guys? Bang, bang. A bunch of you want to bring that trillionaire energy every day, and if you want to do it in your financial life, go use SoFi. SoFi is our exclusive sponsor because we think they've got a great piece of software that'll help you accomplish your financial dreams. Go to SoFi.com/pomp today to get started. You can invest in everything from ETFs to individual stocks to cryptocurrencies to IPOs, and they even have an automated invest function. Head on over to SoFi.com/pomp today, and make sure you come back tomorrow to watch more of the Best Business Show.